As of 12:15 p.m. Eastern Time on Wednesday, January 7, 2026, Novo Nordisk, trading under the ticker NVO on the New York Stock Exchange, is priced at $57.19 per share. This represents an intraday increase of 1.70%, following a fairly strong opening at $56.85. The trading volume is already pushing past 8.8 million shares, which is significant for this time of day. While many investors were watching the tech giants today, something unexpected is happening under the surface of the healthcare sector. Most people assume the story for Novo Nordisk is just a slow battle of attrition against Eli Lilly, but the real development today is the market's reaction to the company's aggressive pricing pivot for its brand new oral Wegovy pill. This isn't just a new product launch, it is a calculated attempt to break the traditional insurance-based distribution model and go straight to the consumer. By offering a monthly supply for as low as $149 for cash-paying patients, Novo is essentially starting a price war with itself to keep generic competitors from gaining a foothold as patents begin to expire in international markets like Canada and India this year. The general market expectation for months has been that Novo Nordisk was losing its grip. After a massive run-up in previous years, the stock spent much of late 2025 in a downward trend as profit warnings and supply constraints cooled investor enthusiasm. People started looking at Nvidia stock or Tesla stock for growth, thinking the big gains in weight loss drugs were over. The common belief was that as soon as semaglutide patents faced their first real tests in 2026, the margins would collapse and the stock would stagnate. However, the reality we are seeing in today's price action suggests a different narrative. The company is trading at roughly 15 times its trailing earnings, which is actually quite a bit lower than the broader healthcare average. Investors are starting to realize that the transition from a weekly injection to a daily pill changes the economics of the business in a way that favors high-volume, lower-margin sales that can be scaled much easier. If you look at the activity on major trading platforms today, there's a clear uptick in interest. Whether you're using the Fidelity mobile app or checking your positions on the Robinhood app, the data shows that retail interest is shifting back toward these bio-growth names. We're seeing a 37% surge in call options volume today, which tells us that institutional traders are betting on a continued recovery through the end of the week. Many of these traders are likely looking at the upcoming J.P. Morgan Healthcare Conference on January 13th, where management is expected to provide more clarity on their 2026 guidance. It's interesting to compare this to how people manage their portfolios on a SoFi trading platform or through Schwab Intelligent Portfolios. Often these automated systems or self-directed accounts focus on momentum, and right now, Novo Nordisk is starting to rebuild the momentum it lost last summer. The intraday movement we are seeing today is largely a reaction to the news that telehealth providers like Weight Watchers and LifeMD are already integrating this new oral pill into their platforms. This creates a massive direct channel for sales that bypasses the friction of the traditional medical system. While someone might use their individual brokerage account at Fidelity to buy the stock, the actual customers are increasingly using their phones to buy the drug directly. This shift in the business model is what creates the tension for the stock price. On one hand, lower prices mean lower revenue per patient. On the other hand, a $149 price point makes the drug accessible to millions of people who were previously priced out. The market is currently trying to weigh which of those factors will win out in the long run. When you look at the broader landscape of online investing, it's easy to get distracted by the volatility of something like Apple stock or the latest news on crypto within a Robinhood crypto wallet. But for those seeking investment help or looking at long-term wealth management, the stability of a company like Novo Nordisk often provides a different kind of value. The company has raised its dividend for 8 consecutive years, and even with the recent price cuts, its profit margins remain above 32%. This is why you see so many Fidelity mutual funds and Fidelity ETFs holding large positions in the company. It's a cornerstone for many institutional portfolios because regardless of the economy, the demand for diabetes and obesity treatment is not going away. If you're using interactive brokers trading tools to look at the technicals, you'll see that the stock is currently trying to break through a resistance level near the $58 mark. If it can hold above that through the closing bell, it might signal a more permanent trend reversal. For those who are active in self-investing, it's important to understand what this company actually does beyond the headlines. Novo Nordisk started nearly a century ago as a specialist in insulin. For decades, they were the go-to provider for diabetics. Their transition into the GLP-1 space with Ozempic and Wegovy was a natural extension of their expertise in metabolic hormones. Their business model is built on massive scale and specialized manufacturing. Unlike a tech company that can scale with code, a pharma company needs physical factories. Novo has been spending billions of dollars to expand its production capacity in Denmark and the United States. This is a huge barrier to entry for any generic competitor. Even if a generic firm in India gets the legal right to produce semaglutide, they still have to build the complex facilities required to make it at scale. We also have to talk about the competition. Eli Lilly is the primary rival, and their product, Mounjaro, has been taking significant market share because some studies suggest it is more effective for weight loss. This is the reality that often hits the expectation of Novo Nordisk investors. However, the market for these drugs is so large that it's not necessarily a winner-take-all situation. Analysts at Schwab or those providing Fidelity Wealth Management services often point out that we are still in the early stages of the global rollout. In places like China and Brazil, the market is barely touched. This is why you see people using various investing sites to compare the valuations. Right now, Novo looks cheaper on a price-to-earnings basis than many of its peers, which is drawing in value-oriented investors who might have missed the first wave of the rally. Comment below how many shares of Novo Nordisk you currently hold, or if you're waiting for a lower entry point. I'm curious to see if you think the shift to a pill format will be enough to fend off the generic competition coming in March. The institutional side of the house is also showing some interesting shifts. If you look at the holdings within a Fidelity brokerage account or a SoFi active investing setup, you'll notice that institutional ownership remains high, around 60%. These large players, including firms that manage Fidelity IRAs and other retirement accounts, aren't usually day traders. They're looking at the 2026 pipeline. Beyond just Wegovy, Novo is working on something called CagriSema, which combines two different hormones for even better results. The company is expected to file for regulatory approval for this in the first quarter of this year. If that gets approved, it could leapfrog the current competition. This is the kind of forward-looking data that the best online investment strategies rely on. They don't just look at what happened yesterday, they look at what is coming in the next 12 to 18 months. As we move toward the final section of today's analysis, we have to consider the risks. The most immediate risk is the patent expiration in India and Canada. While Novo is trying to compete on price, a flood of cheap generics could still hurt their international revenue. There's also the political risk. In the U.S., both parties have been vocal about lowering drug prices. We've already seen government-mandated price cuts for certain Medicare patients. This is a constant cloud over the pharmaceutical sector. If you were doing your own Robinhood stock trading or using a SoFi robo-advisor, you have to be aware of these macro pressures. They can cause sudden swings in the stock that have nothing to do with the company's actual performance. Another factor to watch is the currency exchange. Since Novo Nordisk is a Danish company, the value of the krone versus the dollar matters for American investors holding the ADR. If the dollar weakens, it can actually provide a tailwind for the stock price. This is the kind of detail you might find if you use the Interactive Brokers platform for more advanced research. Most casual investors don't think about currency, but for a global giant like this, it's a significant part of the financial picture. In summary, the current state of Novo Nordisk is a classic case of the market overreacting to bad news and then slowly waking up to a new reality. The expectation was that the company's best days were behind it, get crushed by competition and patent cliffs. The reality is that management is being incredibly proactive. They are launching new delivery methods, cutting prices to grab market share before generics arrive, and continuing to invest in a pipeline that could define the next decade of metabolic medicine. Today's 1.70% gain to $57.19 is a small but meaningful sign that the sentiment is shifting. Whether you are using a Fidelity trading platform to build a long-term position or just doing some quick Robinhood investments to catch a swing, the key is to stay focused on the fundamentals. The demand for these treatments is real and growing. The company's ability to manufacture at scale is a competitive advantage that is hard to replicate. And while the competition from Eli Lilly is fierce, the market is plenty big for two giants. The next few months will be critical as we see the full impact of the oral pill launch and the first of the patent challenges. If you're managing your own money through an interactive broker's account or taking advantage of Robinhood fractional shares to build a position over time, keep an eye on that $58 resistance level. A break above that, especially on high volume, could open the door for a return to the $60. For now, the stock is showing resilience. It is navigating a difficult